In this conversation, I interview Hugo Philion, the co-founder and CEO of Flare Networks. Flare has raised over $11 million with over 50 people, and they are aiming to be the interoperability chain connecting all smart contract chains, non-smart contract chains, and Web 2 APIs together. We talked about bridging, what bridging is, where the faults and hacks and the $3 billion that was lost this year due to bridging failures happened, what the future may look like, what Hugo and his team are building. Then we kind of extrapolated on some other ideas, the impacts of the FTX collapse and other existential risks and opportunities in Web3. So I hope you enjoy this conversation. Here is Hugo. All right, Hugo, welcome to Around the Coin podcast. Thank you for hopping on today.
Thank you for having me.
Yeah. Let's start with Flare and what Flare is and how it's evolved. I'd love to just hear the overarching story of maybe where you guys started and what you saw as the initial opportunity and where things are today.
Absolutely. And so I'm co-founder and CEO of Flare, and I started it with our CTO, Sean Rowan, and our chief scientific officer, Dr. Mary Usha. And really, we started out in 2017, just looking at what could be done in crypto, what's interesting in blockchain. We really started looking at consensus algorithms. And then we started looking at, okay, there's a lot of, interesting networks like Bitcoin, Stellar, XRP, lots of these non-smart contract tokens. How could we build a layer that essentially allowed people that are holding these kind of new forms of value to do more with them? So, Ethereum came along and kind of invented the idea of a global computer, but that's at the time it was, and still, to a very large extent, it's pretty much restricted to people that hold ETH and tokens issued on ETH. Sure, there are some bridges, but they're not, they haven't been fantastic and performed well. People have lost close to 3 billion this year.
Wow.
In bridges, which is a lot of money to lose. So we were looking at how can we enable those networks that don't have smart contract capabilities to have smart contract capabilities, because you've got a large amount of people and a large amount of value. And really we've gone, that's kind of where Flare came from, but where it's kind of going in the last 2 years, we've been looking at really, if you want to sort of sum up Flare, it's a blockchain, smart contract platform, uses the EVM. Uses the EVM principally because that's the easiest thing for developers to use right now. There aren't any competing virtual machines, or let's call it, abilities to write smart contracts that have been, broadly popular. EVM is still, let's say, probably 90% of the market. If that changes, we'll change with it. So there's a EVM layer 1, but it's really structured around 2 things. Well, one overarching objective, getting data onto the chain from external sources so that you can build richer smart contracts. This is really important because ultimately, I think a lot of what we've seen with the speculation of the last couple of years has been because at the moment, what the whole blockchain financial ecosystem is incredibly self-referential. I think if you look at blockchain, there's essentially, if you look at DeFi, there's the principal model of DeFi is ultimately people borrowing US dollars in some form.
Mm-hmm.
And that's pretty great use case, but we can do a lot more. But we need data in order for there to be actions. So Flare has 2 core protocols. The first is essentially a native oracle for probabilistic data. That sounds complex, but think of it as prices, stuff that moves over time. And then it has a native protocol, and we really think it's the most robust possible way to do it currently for deterministic data. So what has happened on another system? So for instance, a deterministic piece of data might be that you have sent some money on Bitcoin, or some Bitcoin, or on Dogecoin to another person or another address. And from that data, you can do interesting things. So, one tiny, small, little interesting thing you can do that certainly not staking the future of Flare on is you might be able to buy an NFT on Flare with a payment directly on Bitcoin or a payment directly on Doge, because Flare can read that and then release the NFT. Flare can essentially come to consensus over that and then read the NFT and then release the NFT at the smart contract level. That's kind of the overarching thesis of what we're building smart contracts with much richer data. We have some really interesting areas that we're looking into how that can be applied.
And the reason it's rich is because the reason you use that word is because you're able to scrape or read other blockchains, and then you can create a smart contract using the data feed from other blockchains. Is that the correct way to think about it?
So scraping and reading are kind of soft. Can't be very certain of the data. There are lots of different ways to do this. We are, I suppose you might call it, proving the data on Flare. And this is the riskiest part, or one of the riskiest parts of blockchain, right? Which is, how do you understand an external system without being centralized? So, you've had a lot of oracles that come along and ultimately they're centralized. If you really want a decentralized kind of future, then the protocol you're using to understand what has happened on an external system has to be meaningfully decentralized. And we have a lot of thoughts about, applying things like proof of stake to such a protocol. Like, then you can only ever be safe up to a certain amount of value.
Mm-hmm.
So
okay.
We've done a lot of research in this area, and that's kind of where we're interested in sort of going forward.
And how do you define an oracle? What is an oracle?
So an oracle is a system that allows you to get data from an external source, right? It's basically like, we call Flare state connector like the eye in the sky, right? And there's lots of different ways you can construct them with various different trade-offs. So for a price oracle, that's kind of like a soft proof. You can't prove something that isn't deterministic ultimately. Like, if you say, what is the market price of Bitcoin? Well, it's different on different exchanges. It's different by fractions, and it's different as to when you look at it. So you can't really prove the price anywhere. But what you can do is you can create Schelling point within a properly decentralized oracle, which essentially allows a true decentralized system to come to essentially an agreement that this is kind of roughly where the price is.
And a Schelling system, is that referring, conceptually, is this reading? I would imagine you are looking at the different exchanges, or what would be the access point to collect the data?
Yeah, at the moment on our Canary network, which is called Songbird, it's been live since 2021, September 2021.
Great name.
Thank you. We have what we call the Flare time series oracle. And that takes the native token, so the native Songbird token, and people delegate to what we call price providers. And currently we have about 86 price providers that are live, and we have about 120 that are registered. So quite a sizable number of price providers relative to basically any other price oracle in the space. It updates every 3 minutes, and each one of those price providers is essentially calling the APIs of all the various exchanges and putting their best guess of the price into the network. And essentially each price provider gets pricing power from the people that delegate the native token, Songbird, to that oracle, to that price provider. And then Songbird aggregates those prices, takes the centers that cuts off the tails, and you don't get outliers, and takes the weighted median of that distribution. And it's been live for over a year. It's been really robust.
Interesting.
And frankly, we've done quite a lot of analytics on how it's performed. And it's been a really stable, really valuable price source for.
Yeah. So curious about this. Okay, so you have are these 80 different people or organizations managing each an API to exchanges? And why not just have the direct API connection yourself? Why go to all the work of building out this Songbird ecosystem and bringing on all these different
Yeah.
pricing, scraper
So,
API
so the problem
callers?
with just having the API on a blockchain is ultimately someone has to run that API infrastructure, and that person or entity becomes essentially a centralizing point in the system,
Hmm.
which means that, if they decide to change the price because you've got a DeFi protocol which they can liquidate a large participant, they might change the price in order to
Oh,
essentially, benefit themselves. And so you really want to have as decentralized system as possible. So for instance, in our Oracle system, if someone did try to put in a bad price, but the others are honest, they would be, their price would be outside of the distribution that is captured. Essentially, we capture the center of the distribution and their price would be in the tails of the distribution if they're putting in a false price to try and liquidate someone. So the Oracle problem is a really hard problem.
when you say the Oracle problem, are you referring specifically to the problem of collecting the price for different cryptocurrencies? Is the hard part?
That bit's easy. The hard part is how do you then get that onto a blockchain without creating, a series of attack vectors for essentially the parties that are operating that Oracle to be malicious and to essentially erroneously take money from other people.
Got it. Okay. And when you first thought about this problem, did you look at it and think that the hard part is, and where the value creation is your ability to safely, in a decentralized way, collect the pricing, accurate, up-to-date pricing of different assets that are out there, currencies that are out there? And if you could do that, then you could facilitate smart contracts and all sorts of other things. Was that kind of the way you thought about the challenge?
Yeah, we actually looked at the challenges. How do we get Bitcoin, XRP, Dogecoin, all those large sources of non-smart contract value onto a blockchain that has smart contracts so it can be used? And really, the first part of that for us, in order to do it in a decentralized way, was to have their prices.
And right.
But
And that's where you came up with Songbird.
Well, that's where we came up with the FTSO, which is one half of what we're doing,
Hmm.
or one component of what we're doing. The other protocol, in many ways, look, there are lots of price oracles out there, and we're not actually trying to compete with them.
Hmm.
We just wanted to build something for our blockchain that we felt was truly decentralized and best in class. And it's really nice to do this at the network level, where you're actually using the network token to secure a price oracle. The price oracle is only a little bit of what we're doing. I would say, the much bigger aspect of what we're doing is the state connector. Because the state connector is we describe it internally. It may not be strictly accurate, but we describe it as a true consensus protocol for proving events, so non-price, so non-probabilistic events onto a blockchain. So for instance, that example I said earlier, which is, Mike has sent some Bitcoin to Hugo on the Bitcoin chain, throws that onto Flare so that can trigger something in a smart contract. And from those two protocols, a huge amount of things can be built. All types of different bridges, all types of different messaging services across chain, because you can then set up, an example of a protocol that can be built using Flare is a simple relay protocol, whereby relay nodes are external to a blockchain and they sit between blockchain to relay data to different chains. But how do you secure them? Well, you can secure them by staking them on Flare and then using Flare to prove what happened on chain A, what message was delivered to chain B, and then if the relay node has lied about that message, you can slash that node because they're staked on Flare. And you can slash that node because essentially Flare can prove what has happened on both chains. And to us, these two protocols, price and stake, so proving, coming to an agreement over what the price of something is and coming to consensus over what the state of another blockchain is. These are kind of like the primitives to build a really wide array of very robust interoperability protocols, starting with bridges and relays, all types of different bridge, however you want to structure them. We have our own thoughts about how to do that, but anyone can come and build a bridge using Flare. Anyone can come and build a relay building Flare, can structure it however they like. And that's sort of our thesis. Flare is a layer for enabling interoperability between lots of different chains.
Gotcha. Okay, that's a good way to explain it. So pricing and state, the ability to see what the price is and the ability to see what people are effectively doing on those other chains. When you use the words relay and bridge, what are I approximately know, but I want to make sure I'm exactly understanding you. What is the difference? How do you define a relay and a bridge?
So I guess, for me, a bridge is very simple. It's moving a token across chains. Now, that's wrapped, like it's a wrapped version, right? So you would have Bitcoin on one chain, obviously on Bitcoin, and then a wrapped version of Bitcoin on Flare, or potentially through Flare to any other chain. Let's say Bitcoin on Ethereum, Bitcoin on Cosmos, Bitcoin on Polkadot, using Flare's, bridges that people have built on Flare.
And how about a relay?
So relay is information between chains. So in the same way that Flare comes to consensus over what has happened on a chain, a relay enables that same data to be moved between different chains, not just Flare.
Gotcha. And of between the relay and the bridge, which is more technically challenging? You mentioned 3 billion was stolen or hacked through bridges this year. Do relays face any sort of
both are absolutely minefield of security threats, right? So the reason why bridges have been, in the news is because that's what people have been using. Relay of data is something that is almost certain to be a very large product in the future, as essentially lots of applications need to go multi-chain, will go multi-chain. The thesis that there's going to be one chain to rule them all, I really feel is a little misguided. It's just like, it's not what we've seen to date. And it's probably not how the world works in general, at least when it comes to blockchain. And so I think relay will be a huge area of development in the space, but it's equally littered with, complexity. Because ultimately those messages that you're carrying across chains have value, because if you deliver the message and it's incorrect, that might trigger something in the smart contract that causes a loss that would not have been, that loss wouldn't have happened if that message had been delivered correctly. So I think both are equally risky areas. I've seen a few products come to market in the relay space, which I've found hard to understand their safety criteria. But yeah, so, we obviously have our own thoughts on how to build these products and researching that internally to make sure that, we're very interested in building on top of our own chain. Let's put it that way.
Yeah.
We have some things we're definitely doing, but the state connector goes a lot further than that. Potentially, the state connector can prove lots of things from external systems, not just blockchains. And that's where things become much more interesting.
I want to go in this direction. I want to ask you just on the bridges idea, since you're so familiar with this. 3 billion was stolen or hacked out of bridges this year. What did people believe was true? What did we learn as an ecosystem around the construction or the analysis of bridges? How did these attacks consistently happen? What was the fallacy?
So I think they weren't all for the same reason, right? For instance, one of them was a really sophisticated attack on individuals who were essentially operating a bridge. Right?
Okay.
So it was an attack on their infrastructure. So one of the core reasons we built Flare is that broadly, the largest bridges have been what's known as a multi-sig. They tried to obfuscate this by calling it other things and having, an NPC layer in the middle. And so it's not strictly a multi-sig. They're essentially sharding the keys and essentially, but ultimately when you boil it down, it gets back to say 8 to 12 people signing for something across chains. And that's an inherently non-decentralized system. It's inherently weak, and it's also really custodial.
Is that because 8 is a small number? Like if it were 80, it'd be better? Or
I don't know if it would be better. I mean, ultimately, how many people does it take to get in a Telegram chat and convince them to steal the money? Like, I don't know how. I don't know. That's just not the style of bridge that we like, right? It's like, for me, it doesn't matter how large the multi-sig is. Ultimately, I think the recent shenanigans in crypto have shown me that if a bad actor can do something, it will eventually happen.
Mm-hmm.
And so for me, I don't care if you make your multi-sig 800 people. If I only need 600 of them or 700 of them in order to be able to steal the money, it's just not that hard to achieve, right? And by the way, when you get to 800 signatures, you're starting to reach a point of, it's impossible to actually sign that on chain. So that's why people build things like NPC and stuff like that. But it's still a very large message. So for me, that's the key problems we've had with bridges are centralization, poor code, and poor code was probably one of the biggest ones. Like Wormhole, there was an attack. They spotted the attack. They were just about to push the update, and just before they pushed the update, someone compromised the bridge because they either spotted the update in GitHub or it was, I don't know. There's rumors, but I'll try not to libel anyone. Anyway, and that was not neither here nor there. What's really bothered me about bridges has been essentially they've been constructed with very little risk management in place.
Mm-hmm.
Right? Like they've been constructed with this idea that, we should be able to bridge all of the money across the bridge in one step. Like,
yeah,
okay, but it's a financial product, right? You don't want to have any risk management. You don't want to think about risk. You don't want to think about what happens when something goes wrong. So we've put forward, if you've read our papers, we put forward a bridge design, which we're very, happy to be working on, called Layer Cake. And what that does is it essentially reduces the risk surface. It reduces the risk surface by allowing the bridge to be collateralized. And what do I mean by that? So if you think about a physical bridge, you have a roadway.
Mm-hmm.
That roadway can only handle a certain number of cars. And if you think about the number of cars that it can handle in, say, 1 hour, the maximum number of cars, that's our collateral. So we essentially have collateral for all the funds that are in transit. Right. So let's say we have $1 million of collateral on a layer cake bridge.
Mm-hmm.
That means $1 million can flow across the bridge in one time step.
Okay.
So we reduce our risk by essentially setting a bandwidth limit, $1 million, rather than all of the value of the bridge in one go. So if it's attacked,
Right.
you can only take $1 million.
Right.
But even then,
yeah.
Then, if it's attacked, we've got the collateral. So essentially, our bridge providers would be underwriting the risk of the bridge. And in fact, they're actually underwriting the risk of themselves being malicious.
Mm-hmm.
That's why we have the collateral. So you have this set of providers that operate the bridge. Fine, absolutely. But how do you make that trustless? You make that trustless by collateralizing them and then making the amount that can cross the bridge the amount of collateral they've put up. So they earn fees on their collateral, but if they're malicious, if the bridge gets attacked, they obviously pay out. So it's like insurance for a bridge. If you
It's kind of interesting. Would it be fair to say that the analogy is like, in order for me to drive my car over the bridge, I have to have another car that I put in collateral. So in case my car falls off the bridge, then I have another car to stick on there.
I think that's pushing the analogy too far. I guess it's more like the manufacturers of the bridge will give you a car if the bridge eats your car.
Got it. Yeah.
Right? That's the point of it, which is if the bridge goes wrong, principally, if we get the code right, the bridge will only go wrong because the operators of the bridge became malicious.
Right.
At which point their collateral is used to pay out whoever they stole from.
Yeah. And is that a change in the typical bridge design? Do typical bridges now have like a throttle limit where they say like a bridge can be full?
No, none that I know of. So there may be. I'm sure there's lots of designs out there, but none of the major bridges have a throttle limit. We have a throttle limit, but ultimately you can still bridge back as much as you like. It'll just take longer.
Right. And the idea would be you have instead of increasing the size of one bridge to be huge, you just add multiple bridges. So you have collateral for each new bridge.
I mean, we would generally have collateral on one bridge for one asset, right?
Okay.
So like if it's a bridge dealing with ETH, the collateral would be in ETH. And then we'd have another bridge for a different token.
Mm-hmm.
And going to cost probably a bit more than conventional bridging. But if you don't lose 100% of your money, I think that's the worthwhile trade.
Yeah, right. It seems like people are willing to take a fee in exchange for security. And that, I mean, it's like, I think if people learn anything, it's probably that. It's like, I'll pay a few percent, whatever, if I could guarantee it.
It's also really important for the downstream ecosystem, right?
Mm-hmm.
So let's say you're a developer and you want to build on a chain and you want to build a DeFi product for something that's being bridged that includes, say, an asset that's being bridged from Ethereum. If that asset's not safe, the value of your product, value of the ecosystem you're building goes to zero or close to zero.
Mm-hmm.
Because, let's say you're a lending protocol and you're using rat teeth and you're letting people borrow something against that rat teeth. If that rat teeth isn't safe, collateral in your lending protocol collapses. And then your all that hard work you've done, you and your team and your community managers and all the people that, put TVL in to get the tokens, all of that's undone because of an unsafe bridge. And we've seen that a lot. We've seen, I think it was Moonbeam that really, really suffered on Polkadot. I think it was Moonbeam. I could be wrong. Really, really suffered. One of the chains really suffered from the bridge going wrong. It basically, they had to lay off a bunch of people.
Mm-hmm. Have you been caught either through Flare or personally in any of these hacks or?
I haven't.
And do you suspect we're in the tail end? Do you have any ideas to how long this ripple effect of, seemingly this idea of like collecting customer funds, reinvesting it into the market, and then the market goes down, you don't have the money to pay back customer funds. That's
so let's be clear. There's absolutely no bridges that I know of that have done that.
Oh, right. Yeah. No, not bridges. Yeah. That would be more like
yeah. But what I would say is like, a couple of the bridges bailed themselves out through parent company funds.
Mm.
I would be very circumspect that given the bear market in crypto, the parent companies can be prepared to dump up that cash again.
Mm-hmm.
If anything goes wrong this time. And so, what we're trying to build with Layer Cake, or at least what we've conceptualized, what we've put down on paper, and what we're researching is how do you build a bridge where the insurance is native to crypto? Well, you get that from the bridge operators, and that it's self-regulating. Again, bridge operators and the ecosystem around it.
Mm-hmm.
And provided our code doesn't break or that doesn't cause an unexpected, issue, then the risk, essentially what we're trying to do is de-risk the entire bridging structure and and then cover the only risk that remains if we're successful at de-risking it, which is the risk that the operators of the bridge become malicious. And that's why we built a canary net. That's why we have 2 different test nets. We do a lot of testing before we release anything. Perhaps an ungodly amount of testing. I would have liked to, as CEO, I would have liked to have gone a bit faster, but I'm very glad we haven't. And yeah, so we do a lot of testing, and we work with the auditors the whole way through, from inception to the end of the product, with the idea that, rather than having an audit at the end of the build, where an auditor has to go through thousands of lines of code, maybe thousands of lines of code in, say, a couple of weeks. If you work with them from the beginning, then you're going to end up with a group of people, a group of external auditors who have a substantially better understanding of what you've built.
Yeah, it makes sense. Sounds like the right way to do it. I want to ask you this question. This is something I've been wondering about for a while, and I feel like you're qualified to answer it. Albeit it's quite abstract. So if I think about traditional finance and the trade-off of safety, security, and price, there's a certain fee, there's a certain cost for that system. For me to use a Visa MasterCard, it's like 3%, and virtually all merchants pay that roughly approximate number. There's costs in order to use a Fidelity brokerage account. There's costs everywhere. They may be baked in, they may not be obvious, but you could get to some percentage fee. In crypto, you have a different set of trade-offs between cost, security, decentralization. How do you think about maybe the convergence of cost specifically? Do you think that in the traditional finance is
I think this is really interesting, because it's something that people kind of forget, right? The reason why your bank, used to pay you interest, and probably does now pay you interest again after the interest rates having gone up, although I must admit I've not seen it. And it seems to be a bit slow. The reason why your bank does that versus you paying a fee to store your funds at a broker is that your bank doesn't have the money you have at your bank isn't yours. The bank's using it. Right. So that's kind of like the exchange model that's been,
right.
Pretty much.
Right. Sorry to interrupt you, but that same exchange model collapse was the post World War II. That was the Great Depression collapse, the run on the banks, thousands of banks.
That, or, 2008, which inspired our whole industry, right? Which is, difference is in crypto, there's no central bank that's going to come along and make everything right. Not to say that they did make everything right. Let's be very clear. I mean, I still don't think we've actually seen the effects of what the central banks did. We haven't seen the full gamut of effects of what the central banks did actually after 2008. And I think we're basically still in that cycle, right? But at least they stopped the banks from completely collapsing and everyone having no money one morning, right? There's no lender of last resort in crypto. There's no one that's going to come along when Sam Bankman-Fried loses all of your money, and say, Sam, don't worry about it. Here's a credit line. Just give up your equity and one of the big boys will buy you out. That just can't really happen in crypto. The good thing it can't, ultimately. But unfortunately, that means that we are exposed, if we're going to use centralized models to store our money, rather than using a device, like a ledger or a wallet. If we're going to use centralized models and try and get some income on our money, and that's the risk we're exposed to. We're exposed to, people making bad decisions about what to invest in, and people's egos getting too large to admit failure.
And okay, so do you feel that there is would we converge on an equal price, maybe like 5% of all every year. There's a 5% tax to just have a financial system, regardless of it's centralized or decentralized, that will eventually
Well,
converge on some fee
so
structure.
I think if you, at least we've taken a lot of, I guess, inspiration from the traditional financial system to try and make, to conceptualize and build products that are just like better than others.
Mm.
Right. So our bridges and the bridging model I just spoke to you earlier, it takes this idea that ultimately you pay a fee to the person operating the bridge, but they pay you out if they are corrupt.
Mm-hmm.
Right. If they steal your money from the bridge holds their money, and a smart contract can verify that they've stolen your money, and you get bailed out with their money directly.
Mm-hmm.
So this is exactly the model we're looking to kind of, I guess, put forward in crypto, which is you want to do something exotic, like move between chains, when chains were never built to be moved between. Then, you pay the toll, but you get safety.
Mm-hmm.
And I think it's a fairly natural model, right?
Yeah.
And to be honest with you, the banking industry may have collapsed many times, but I don't think the insurance industry has.
It's a good point. Yeah. And so is that because the insurance industry is effectively forced by the government to keep a large pool of collateral because there's a cost in that, if you have $1 million in collateral that's sitting there under that bridge, that in case something happens to the bridge, you can't loan that out. So that's interest you're not making on that money effectively, which is the correct way to think about it. Because if you look at it as a lost opportunity and you start lending out that million, well, what if the hack on the bridge is the same reason that people, what if the hack on the bridge affects the money that was lent out? And that's where it's like everything dries up all at once. And that's where
exactly.
It's all linked together.
That's why you got to pay for it, right?
Mm-hmm.
You're essentially, the insurance is being provided by someone else's money. You got to pay an interest rate on that. And ultimately, everything has to harmonize to whatever else is available in the world. And traditional finance is available. And if people aren't paying fees in crypto, and they are paying fees in crypto, then essentially people won't deploy capital to crypto unless they can make an equal return adjusted for risk relative to traditional finance.
Yeah.
So, if your volatility in traditional finance is X and your volatility in crypto is Y, then, adjusted for that volatility, you have to be able to make essentially the same return, if not slightly higher, in order to attract capital to crypto. And that's the model we're looking to really kind of put forward into the system, certainly with layer cake bridging.
Yeah. It seems to me that if you almost take this from a even higher abstract perspective, there's something that I think people are resistant to, or maybe don't completely have their mind wrapped around, this idea that preserved value, so money in this case, that is not being lent out, is effectively, it's like, it's a value that you can then cash in on in the future. Whereas the other way around, if I take on debt, I'm borrowing from the future. It's like, if you hold money, you're giving to the future. If you borrow money, you're taking from the future. So if the future is a downslope, like things aren't as productive, something happens in the world, there's chaos, we need to cash in on those reserves, and you don't have those reserves, then it's like, I almost think of this in water because it's more physical. It's like, for me to have 50 gallons in a storage tank is great. For me to have 10 gallons is still fine. But for me to go from like 5 gallons to 0 gallons, the cost it's just infinitely worse. So it's like, for me to,
Sure.
So it's like, there's some balance where I look at this and think of this from an abstract perspective. What's the correct amount of, we say this word insurance, but it's like allocation of value to the future, reserves that you're not lending out, that's not in the market. Maybe the water concept to me rings true, but you could just use money. And that it's maybe in the future there's a drought and we need to cash in on that. And then the value that's stored gets compressed, but you still have something. Like to have $0 in circulation, to have zero water is just, the game's over at that point.
Well, the thing about insurance and all major insurance companies is they have massive investment portfolios, and they manage their risk pretty well, right? They keep a certain amount of cash on hand to pay out. But if they're not putting that money to work, then they won't be able to cover the risks that they've insured in the future, because they're only insuring risks based on a premium and also an assumption on how much their capital pool is going to grow. And anything if you look at, say, Berkshire Hathaway, which is essentially a vast business conglomerate that has largely been built on the back of a very large and successful insurance company. And essentially what they did was that they insured risks at a sensible premium, took that, took that income, deployed it into things they thought were massively undervalued, or a portion of that income, put it into things they thought were massively undervalued. And over 50 years have built one of the largest companies in the world. Like it's actually a really great business. And what we're, I guess, looking to do is we're looking to allow people to deploy their ETH, their USDC, their USDT as collateral into bridges for which they earn the bridging fee. And so essentially they get an income from the collateral they're sitting on. And the bridge itself is providing a service. And they can roll that income back into the bridge or into other products or whatever. But, it's a very simple model.
Yeah.
It's one that has been deeply overlooked.
And it seems like you could take this same idea of it's almost like crowd-funded, maybe I won't use that word, but it's, an insurance company is centralized. It collects the money. This would be more decentralized. You could take the same idea and apply it outside of bridges, right? I mean,
absolutely. Look, there are insurance, I guess, DAOs on blockchains, right? It's pretty nascent, but I think it's a fantastic use case in blockchain. And I mean, one of the things we think about, like, shill flare here for a second, right? Is if you're running an insurance DAO, you want your risk to be as diversified as possible, right? If you're running an insurance DAO that is covering DeFi, you may not want to have 100% of your exposure to that DAO to a single DeFi ecosystem. So, if you're in insurance on blockchain, what would be an interesting place? Where would be an interesting place for you to go? Well, maybe a chain that can prove events from other chains. So can prove that there's an insurable event happened and pay out upon that insurable event, but allows you to create an insurance pool that is diversified because it doesn't just do it for one chain. It can prove events from multiple chains. So you can be simultaneously, essentially insuring many different chains, and therefore diversifying the risk of your insurance pool, which ultimately over time should reduce premiums.
Can I ask you a question kind of related to this, just continuing with this idea? So could you go even further and say we wanted to create, fire insurance for your house? And we say we're going to do it on chain, but the way that we'll verify on chain whether or not your house has been burned down is we'll have the people who stake the money in the insurance pool will be presented with the evidence, and then they'll vote and say, do you agree that, here's pictures, here's the story, here's all the offline, off-chain data.
So you can do it that way. Like, DAOs, is what you're talking about, governance. DAOs are pretty weak at the moment in terms of there's some nefarious events that happen with DAOs because, like, say, one person owns one entity owns the majority of
right.
That's the problem there, is you may not have insurance. What we're looking at more, candidly, is can the state connector, our protocol for understanding other blockchains, can it be reliably applied to other systems? Where we'd like to go with that, if the research bears fruit, which I think it will, is can we prove, from a system like I don't know how it works in the US, but let's say there's some database somewhere that says house X has in fact burnt down.
Mm-hmm.
And people are prepared to trust that database.
Right.
It has to be trust because
Right.
ultimately the data has to come from somewhere. But if we can prove that house X has burnt down, then there could be an insurance product on a blockchain.
Mm-hmm.
And that is interesting. In fact, the whole area of can you prove something from a non-blockchain system, i.e. a database or a website, that's very interesting to us.
Yeah. Yeah, that does seem like, to me, whether it's the house burning down or the car crash or somebody dying or somebody being born or somebody, whatever the off-chain event is.
I mean, it goes to so many things, right? Like, if I can do stuff if I can prove something from a website, let's say Twitter, I can do micropayments against like hashtags. It's the whole advertising model there. The whole, like, I think about this a lot, like micro instances.
Mm-hmm.
It's like, I'm not Kim Kardashian, thank God. And no one's going to pay me $1 million for shilling something. They might pay me like 2 cents. Okay, I probably wouldn't do it, but other people might. There's a whole, if you can start proving things from Web 2 onto Web 3, you can break open entire you can create entirely new models
Mm-hmm.
of how Web 2 is monetized. And actually it's an area we're researching aggressively.
Yeah. And also complemented by the fact that there's a decentralizing effect happening on attention in Web 2. It's like my brother started a company called Cameo that allows people to connect with celebrities and they do shout outs. But that worked because, like, to your point, you went from a few major celebrities, a few large channels, CNBC, CNN, ABC, to now 10,000, and everyone splinters. So there's all these little clusters of people. So how does that affect the world?
Just like a YouTube.
Yeah,
I mean,
exactly.
you're just getting more and more people putting out actually genuinely more and more interesting content.
Mm-hmm. Mm-hmm.
Right. And the only way that's currently monetized is by someone else selling ads and giving them a cut of the revenue.
Mm-hmm.
Like, there are potentially other monetization models. If you can either build a platform, although I think that's really hard, to build a new platform and attract people to it.
Mm-hmm.
You've seen people like Mastodon try to do that kind of stuff, and it sort of hasn't worked great till now. For me, it's like, can you use Web3 as a monetization layer on on top of what has already been built?
Mm-hmm.
Because you can prove the data onto Web3. That's kind of an angle that, myself and the team are heavily researching.
How has the collapse of the 3 arrows and the Celsius and SBF or FTX, how has that affected the product development or anything else related to how you guys are working or how other people are working?
So for us, it hasn't had a direct effect. We were never in FTX. There's been no direct effect for us. It's obviously had a chilling effect on the industry more generally. People are scared. People are conserving runway. Just means less is going to be built.
Mm-hmm.
It's also, there's less anticipation around the industry right now. Check sizes and smaller, valuations and smaller. It's healthy, ultimately. I mean, to be honest with you, my view of the last couple of years is, and what's been funded and what's been popular is pretty dim.
Mm-hmm.
I think it's been a lot of very quick to market, not very well thought through things have been funded. A lot of the things that got a lot of interest were basically essentially a souffle where, some large backer would dump in a bunch of money, essentially pump it up and try to pull out a bunch of money. We've been at this since 2017, perhaps thinking about how to do things well, and build a genuine product in the space that works, that's useful.
Mm-hmm.
Like for me, I'm like, I've been semi, the last couple of years have been really hard watching people do things that have largely been not useful. And I think as an industry, we really need to take a lot of blame because we haven't attracted billions of people to the industry. You've built nonsense, actually, broadly.
Yeah. Where do you think the real construction and production is happening now and maybe the next few years? Like, where will we cash, like even from Flare or other similar networks, where are people using this? How does it cash out to real life now? And then how do you think it will?
So I think there's a huge move to scaling. There's a huge move to sharding. These things are practically necessary prerequisite for a blockchain industry to be able to scale to the billions of users, right? So like what people like Ethereum and Polygon and all the various different networks are doing is that they're essentially attacking the core infrastructure challenge, right? And I think that's incredibly important because the core infrastructure, at least at the smart contract level, is not yet good enough. If we had a product that got the usage of Instagram, we wouldn't be able to handle it. Like it wouldn't work.
Yeah.
It would just be too expensive to use. And so, that's where the real work is happening. And then, for us, we're obviously very consensus focused. We still have a active research thread internally with regards to how to build consensus algorithms. But we're also looking at, once you've got a consensus algorithm, that's really good, and a way to scale that, and all the various other things that people are doing. How do you get sufficient things onto the chain, sufficient pieces of data onto the chain without using soft mechanisms, right? So like you mentioned that fire example, and I think it's interesting because like that governance mechanism just like so corruptible.
Mm-hmm.
And like, this is what's been built for the last couple of years in crypto. It's like super corruptible methods because they were cheap and easy and quick to put up. And people would throw $20 million, $100 million at them. And for us, we're thinking about, how do we prove things like genuinely onto a chain and actually get usage? Then, others are thinking about scaling. And I think hopefully those two things come together whereby you've got super scalable blockchains and really, really good data. And then people can actually start building products that can hit 1 billion people.
Yeah. That's what and where do you see it like happening first? Is it, you think real estate, funding, insurance, financial tools, social media networks? Like where will people say, this is it, I'm using?
So I think like what blockchains are really good at is figuring out financial models, like DeFi, right?
Mm-hmm.
Absolutely excellent. But they're financial models almost like, but with no market or minimal markets to serve, right? As I said at the beginning, I think broadly, like it's been, how do I borrow US dollars? Cool. Great. So that's like DeFi today. Sure, there's lots of other things that happen in DeFi, but like I'd say broadly, the biggest use case is how do I get USDT, right? How do I borrow USDT? So that maybe I can buy another token or whatever you want to do with that USDT. How do I get it? I think that's been this huge winning use case. It's been fantastic. And actually DeFi is amazing. Like it has created a truly in some ways, decentralized financing system. But today, with very little to finance, that's the problem.
Yeah.
And so then if you can match what's been built, which is a really great financial system, with lots of use cases, lots of genuine use cases, which aren't just like guys and girls with like blockchain logos on their laptops, but like lots and lots of actual people, then I think then I think the fruits of DeFi will actually be borne out,
Mm-hmm.
But that's kind of where I want to see this go. And where do I think it gets applied first? I think, gaming
Yeah.
is sort of the most obvious one, and then social media.
Mm-hmm.
Because, if you look at like social media, the vast lion's share of the income probably goes to a very small amount of people, would be my guess.
Yeah.
And most people are consumers rather than producers, or whatever term they may want to use for themselves. My guess is that essentially trends sort of continue such that more people need to earn a living from something that is non-traditional, like being popular on a social network,
Mm-hmm.
or being really good at a video game,
Mm-hmm.
or moderately good at a video game, or moderately popular on a social network. Like those things have value, as well as just being, but having 1 million followers, maybe 200,000 followers also has value.
Yeah.
So the question is, how do you give that person that value? That's kind of the question that we're looking at.
And why is it, what decentralized mechanisms are better than centralized? Because centralized is it's very, very efficient at doing what they do.
It is efficient, doesn't work for small amounts of money.
Mm-hmm.
So for instance, micropayments, that doesn't work great. You have to trust the centralized entity to pay it. You have to trust the centralized entity to know, to essentially say, oh, your tweet or your video or whatever got this many views. That's like quite a big leap of trust, actually, when your income is tied to it. You can be booted off at will. It's not that you're also getting a huge, revenue share.
Mm-hmm.
The entity is getting a very large revenue share. It interests me on whether that structure can be made flatter, fairer, and more democratic.
Yeah, it is food for thought. Hugo, I want to ask you, where are you finding your inspiration? Are there certain people you're following on online blogs or Twitter somewhere, or books? Where do you find yourself consistently turning to learn and enlighten yourself?
I tell you, I mostly find we're now a team of 51 people, and I must admit, we haven't spent very much time together because of COVID.
Mm-hmm.
But recently, we've been spending a lot more time together, and it's absolutely awesome. Really get a lot of inspiration from working with the team. And then I've been reading a lot of different books.
Like what?
So it's recently been, I guess, listening to some of the James Clavell saga. Quite interesting.
Mm-hmm.
I didn't know much about the Iranian Revolution. Not sure that the book I'm reading is a fantastically accurate historical source, but either way, it's entertaining. Podcast. To be honest with you, Twitter is probably my central source of news these days, especially in crypto.
Yeah. And what's your Twitter? Where are you available online personally?
Oh, at Hugo Philion.
Nice. Oh, I'll make
I
sure.
tell you what, it's been absolutely amazing to watch the amazing tragic to watch the unfolding of FTX in real time on Twitter. It's like nothing I've ever seen before.
No, it's crazy. And it feels like there's two stories playing out simultaneously in two different worlds. It almost feels like the fracking of like the Web 2 traditional media, mass media companies telling one story and
Yeah.
then the actual unfolding of it on Twitter.
I mean, that is actually insane. Like how the traditional media has kind of soft-balled the SGX saga is, I don't know. I mean, I hope it spells, I hope it spells a reckoning for traditional media, because it's been a huge dereliction of duty.
Yeah, I think that the most critical interpretation would be that the media companies are intentionally softballing because they were funded by this guy. They received donations. And my thought is it's more middle ground. It's more like they don't really know how to be harder. They don't know. I mean, they look at this guy and he seems like a smart guy who made a bunch of mistakes, and they're like, well, why did you do that this way? Why did you do it that way? And they don't quite know how to be harder, right? I don't know.
I don't know. I watched the Theranos documentary on Amazon the other day, and they took her down pretty well.
Yeah. Yeah.
And she didn't lose anywhere near as much. And it was all private investors' money.
Private investors' money.
Wasn't public. What was private investors' money? They took their risk. She didn't she didn't say, oh, your money's not at risk.
Yeah.
Whereas Sam Bankman-Fried deleted a tweet that said, we've never lent out your money.
Ouch.
And that I find very difficult to handle.
I do think that he's probably taking a very strategic approach and saying, let's go all out. Let's take the exact opposite approach to what a typical lawyer would recommend and just try to win the appeal of the public and have that be influential in the court. Right. Because otherwise, if you're quiet, then there can be a narrative that's created that you're a monster and that influences your outcome.
Well, his approach appears to be that he is an idiot.
Right.
He knew nothing that was happening internally, and that he completely misjudged everything. And, oh, I'm sorry, I'm just a young guy. I need another chance, and all that kind of stuff.
And the thing is, like,
it's a weird approach.
It's going to come out. Like the Slack notifications, the text, the emails, you're not going to hide those. I mean, they're going to be revealed in court, right?
And maybe he did know nothing. I mean, the guy was probably super busy.
Yeah.
But that's not an excuse.
Right.
That's not like, I don't think if JP Morgan went down tomorrow and Jamie Dimon said, oh, sorry, I was too busy to know what was happening at JP Morgan.
Right.
I don't think anyone would accept that.
Yeah.
So yeah, I should probably not get too far on this subject. It's I may say something I regret.
Nah. Well, it can't be anywhere near as bad as what he's doing. Plus, there's nothing wrong with side chair speculating and just observing, making sense of what's happening so far. Because sometimes it diverges from reality. That there's a strong group on Twitter of smart people in crypto and elsewhere in tech that are like, this guy is obviously stealing. And I think that draws a lot of attention. People kind of see through the facade pretty quickly if you follow it. But either way, it's going to be indicative. It's going to be influential regardless. So it's worth paying attention to. Hugo, we'll put all these notes in the show notes. And I really appreciate your time today. Congrats on all the progress so far. I hope you guys significantly influence the direction of crypto for the better. Continue to do so. And thanks so much, man. Appreciate it.
Thank you for your time.
All right. Take care.